Welcome back to Daily Crypto episode 52. Today's crypto story isn't just another headline, it reveals a shift that could dictate where the market heads next. The Bank of America CEO just dropped a massive warning about trillions of dollars moving into stablecoins, and behind this news is a trend that many investors haven't connected yet. In today's episode, we'll break down what happened, why it matters, and the key insight from our sources that could change how you view the market. Okay, let's dive right in and establish our current baseline. Right now, Bitcoin is holding at roughly $61,713. So what's actually happening here? Well, the price is in a bit of a recovery phase right now while central banks continue to tighten up global liquidity. This is the bedrock of today's market reality, right? It creates this incredibly tight environment where every single move by the major players is magnified tenfold. And you definitely need to care about this because this baseline price is literally the anchor for an immense behind-the-scenes tug-of-war that we're about to uncover. Meanwhile, Ethereum is locked in this fierce battle right around the $1,721 mark, pushing against some really serious headwinds. Now, later in the episode, we're going to connect these exact numbers to another trend hidden in today's altcoin data. There's just this stark contrast right now between Bitcoin's consolidation and Ethereum's struggle. And honestly, understanding that gap is absolutely crucial for navigating the risks and opportunities we've got coming up. At first, this seemed unrelated. But let's dive into Section 1, Bitcoin's billion-dollar movers. There is a really fascinating contrast here between two completely opposing forces. On one side, we're seeing massive accumulation. Sovereign buyers like El Salvador are out there claiming daily Bitcoin purchases, and Japan's Metaplanet just announced a colossal $137 million capital raise through a third-party allotment just to buy more. But opposing them is a heavy headwind of distribution. Michael Saylor's capital strategy files indicate a plan to sell $1.25 billion in Bitcoin. It's this monumental tug-of-war between sovereign accumulation on one side and corporate monetization on the other. And this beautifully illustrates the risk side of the equation. Our data reports are flashing some major warning signs right now as massive Bitcoin whales are signaling caution. They're actually moving significant amounts of Bitcoin directly onto exchanges. Why does this matter? Well, usually when whales move coins to exchanges, it precedes heavy selling pressure. If you're an investor, you absolutely need to keep an eye on this because it represents a potential cliff edge for current prices. And there is one detail in the uploaded material regarding the regulatory landscape coming up shortly that changes how the story should be interpreted. But then, another piece of the puzzle appeared, bringing us to Section 2, altcoin action for ETH and XRP. Let's take a look at XRP's market action. Despite a massive 1 billion token unlock, which, is an event that typically crashes prices because of a sudden oversupply, XRP shockingly rallied. It pushed right above key resistance levels. Why? Because underneath the hood, Ripple is building out a serious institutional credit layer. Their XRPL lending amendments, specifically XLS 65 and 66, are currently facing an 80% validator hurdle to pass. It shows incredible resilience. The market isn't just trading tokens anymore, it's actively pricing in major protocol upgrades. Ethereum, on the other hand, is flashing completely mixed signals right now. While the network is gearing up for the highly anticipated Pectra upgrade, Vitalik Buterin himself just sold $1.2 million worth of ETH. Analyst Tom Lee blames the recent decline on Q2 window dressing by institutions, but simultaneously, you have figures like Robert Kiyosaki forecasting astronomical upside to 95K. So what happens next? Well, near the end, we'll look at the biggest takeaway from all these contradictory signals and what it actually means for your portfolio. Just to highlight the real risks of navigating these altcoin waters, consider this crazy micro-story. $18.5 million in Cardano ADA was just stolen in an exploit. The kicker? Absolutely nobody knows who stole it. Not even the company that literally built the wallet. It serves as a really stark reminder of the persistent on-chain risks investors are facing while chasing yield in a market that's still full of blind spots. Now here's where everything connects, moving into Section 3, the global regulatory tug-of-war. Because you see, the charts aren't just reacting to whale movements. They're reacting to ticking political clocks. If we map out these deadlines hovering over the market, we have the SEC expecting a Senate vote on the Clarity Act before the August recess. However, sources indicate this faces sub-50% odds of actually passing. Coinbase is even threatening to pull backing for the bill. Following that, we've got the California default deadline, and ultimately the massive looming cloud of the 2026 U.S. elections, which investment banks warn could stall major crypto legislation entirely. We are seeing intense political crossfire creating heavy market volatility. Just looking at the data neutrally, there are some very objective market variables at play. For instance, reports indicate Donald Trump's Europe tariffs triggered an $875 million crypto crash, while his government filings just revealed $1.4 billion in crypto earnings. Across the pond, a UK backbenchers committee is pushing for an outright ban on crypto political donations, while New York prosecutors push to criminalize unlicensed crypto operations. This total whiplash environment is exactly why smart money is starting to look for an exit ramp. However, the most interesting part came next, in Section 4, the stablecoin shift. This brings us right back to that massive insight we teased at the very start of the episode. The crucial point is captured perfectly in the staggering quote from the Bank of America CEO, warning that $6 trillion in deposits could flow into stablecoins. So why is this happening? Because smart money is viewing stablecoins as the ultimate safe haven from the extreme crypto and political whiplash we just looked at. They want the yield, they want the digital rails, but they want it without the chaotic volatility of the tokens themselves. And guys, this isn't just some wild prediction. The pivot is already in motion. We are seeing Barclays making their very first stablecoin investment with a stake in Ubix. Tether is pushing aggressively into tokenized gold payments with their Scudo rollout. Even political figures are launching stablecoin projects now, though they're already facing intense scrutiny. The institutional infrastructure for a stablecoin-dominated future is literally being laid down brick by brick right now. That's when the bigger picture became clear, leading us into our final section, Section 5, Macro Outlook and Risks. What does this macro outlook actually mean for the remainder of the 2026 landscape? Well, according to analyst monthly reports, despite the massive potential for a stablecoin influx, the realistic range for Bitcoin right now remains bound between $60,000 and $65,000. That massive distribution from whales and corporate sellers, like Saylor, is effectively capping the ceiling, while sovereign accumulation is providing a really firm floor. It's a true market stalemate. So, what should you take away from all of this? Here are our 3 key takeaways. First, the institutional tug-of-war is defining Bitcoin's price. It's trapped right between sovereign buyers and whale sellers. Second, altcoins like XRP are showing surprising resilience by advancing major protocol upgrades, despite heavy token unlocks and market headwinds. And third, the biggest shift of all, the monumental $6 trillion flight to stablecoins as institutions actively seek safe havens from political and market chaos. The market is clearly at a crossroads right now, balancing incredible technological upgrades with heavy regulatory and distributional gravity.